So hello all my dear students of South India. I hope you all are doing good. I hope your studies are going on great for your upcoming examination. So today we are going to revise the next chapter for your CA final, which is a very important topic, that is non-resident taxation in full English. Okay. So let us start with the discussion without wasting any further time. The very first thing that we need to see over here is section 5. What is the scope of total income which is chargeable to tax in India? Before taxing any person in India, you need to identify the scope of total income which is chargeable to tax in India. For that purpose, we need to determine the residential status of an assessee. Now, there can be three types of residents in India, that is resident and ordinary resident, resident and not ordinary resident, and non-resident. As far as resident and ordinary resident is considered, an ordinary resident is liable for world income, whether it is accrued in India, accrued outside India, received in India, received outside India. It doesn't matter. An R and OR is always liable to pay tax. Okay. Whereas the other two, that is NOR and NR, they are liable to pay tax in India if the income is either accrued in India or deemed to accrue in India, or received in India or deemed to receive in India. There has to be some relationship with India for NOR and for NR. Okay. Now, then what is the difference between NOR and NR side? There is only one difference between NOR and NR. Okay. And that comes under PGBP. That if the PGBP is done outside India and if it is controlled from India, then NOR will pay tax, NR will not pay tax. That's the only difference between NOR and NR. Otherwise, NOR and NR are one and the same thing. Okay. I hope it is clear to all of you. Let me summarize for you all once again that for R and OR, world income is taxable. For NR and NOR, only income which is accrued in India or deemed to accrue in India or received in India, deemed to receive in India are taxable. And the difference between NR and NOR is only because of one income, that is PGBP. If PGBP is accrued outside India but control is done from India, then NOR will pay tax, NR will not pay tax. Okay. I hope it is clear to all of you. Now let's talk about the very first thing in this chapter is the residential status. Now residential status has to be understood from different perspective. That is from the perspective of individual, HUF, AOP, BOI, firm, company, etc., etc., etc. So first of all, we are going to learn the residential status of individual, which is very important for your examination. For individual, there are multiple categories. Category 1, residential status of an individual. In category 1, an individual can become resident because of any of the two conditions. That is, if he stays for 182 days or more in the current financial year, or if he stays for just 60 days in the current year and 365 days in the last 4 years. Either he has to fulfill this 182 days criteria, or he has to fulfill the criteria of 60 plus 365 days. Whichever criteria he will fulfill, he will become resident. Okay. Now, can an individual also become ordinary? Yes. To become ordinary, he has to fulfill two additional conditions. Both the additional conditions has to be fulfilled to become ordinary. If he does not fulfill any of the conditions, then he will be called as not ordinary resident. Okay. So the two additional conditions are, he should be resident in at least 2 out of last 10 years and he should stay in India for at least 730 days in the last 7 years. Okay. So both the conditions has to be fulfilled. Then he will become what? Ordinary resident. Now, there are second category. Let's move on to the second category of residential status for individual. The first category is done. In first category, there were two possibilities, 182 days or 60 plus 365 days. Let's move on to the second category. Now, in second category, it is only applicable to Indian citizen, count the condition, who is leaving India during the previous year as a crew member of Indian ship or for the purpose of employment outside India. So if an Indian citizen is leaving India during the previous year as a crew member of Indian ship or for the purpose of employment outside India, for him, the condition of 60 plus 365 is not applicable. For him, only 182 days condition is applicable. Only 182 days condition is applicable. The condition of 60 plus 365 is not applicable. Okay. This is only applicable to these category of people who are mentioned over here. Okay. Now, when they leave India, when they come back India, how their number of days are calculated. For that purpose, Rule 126 is brought by the Government of India. Rule 126 tells us that how to compute the number of days in India and number of days outside India. For that purpose, the Government of India said that the period starting from the date entered in the continuous discharge certificate to the date entered in the continuous discharge certificate. So the day on which the employee has signed in the continuous discharge certificate, from that date till the date on which he has signed off, the captain has signed off in the continuous discharge certificate, that much period should be excluded from India. Okay. And the remaining period will be considered to be part of India. Okay. I hope it is clear to all of you. So how they compute that period? The government has told us the date entered in the continuous discharge certificate, sign-in date and the sign-off date. Between whatever is the period, that much period will be out of India. Okay. I hope it is clear to all of you. Now coming to the third category. Now the third category is applicable to Indian citizen or person of Indian origin. Now you will ask me, who is person of Indian origin? A person of Indian origin means I can be called as a person of Indian origin if I or my parents or my grandparents, maternal or paternal, either of the grandparents were born in undivided India, then I can be called as what? I can be called as person of Indian origin. Therefore, if I am an Indian citizen or a person of Indian origin, and if I what? if I visit India, during the previous year for less than 120 days. So if I am a person of Indian origin or Indian citizen who is visiting India during the previous year for less than 120 days, then I am non-resident. Now, if I am visiting for 182 days or more, then I am resident. Then whether I am ordinary or not, for that I have to fulfill these two additional conditions. If I fulfill these two additional conditions, then I am ordinary. If I don't fulfill these two additional conditions, then I am not ordinary. What about the people who stays for the between period? That is, if you stay for 120 days to 181 days, and if you stay for which associate I am talking about, not all, an Indian citizen or person of Indian origin who is visiting India during the previous year, okay, and he is staying in India for 120 to 181 days, and in the last 4 years he is staying for 365 days, and his income from Indian source exceeds 15 lakh rupees. His income from Indian source exceeds how much? 15 lakh rupees. Then he will be called as not ordinary resident. And if he doesn't fulfill these conditions, then he will be called as what? Non-resident. One important thing, when you compute the income from Indian source will include one income, that is if the business is done outside India, but if it is controlled from India, that will also be called as income from Indian source only. Suppose if your business is in Singapore, but it is controlled from Delhi, then it will be also called as income from Indian source only. I hope it is clear to all of you. The meaning of income from Indian source is mentioned over here. Okay. So this was the third category. And in the fourth category, which is called as the deemed resident. In this fourth category, you don't have to stay even for a single day in India. Without staying even for a single day in India, you can be liable for what? You can be liable for tax in India, and you can be called as deemed resident. What is the condition? You have to fulfill three conditions. The assessee as an Indian citizen, and his income from Indian source is more than 15 lakh rupees, and he is not liable to tax in any other country or territory in this entire world by reason of his residence or domicile, etc. So if you fulfill these three conditions, then without even staying for a single day, you will be called as a resident. But even in this case, you will not be called as an ordinary resident. You will be called a not ordinary resident. I hope it is clear to all of you. Okay. Now, what do I mean by the term liable to tax? That is also defined over here. Liable means there has to be a liability on you. Okay. But even if it is exempted under the foreign law, then also you will be called as liable. There are two kinds of people who can be called as liable. One is a person on whom there is a liability and he is paying the tax. Another is a person on whom there is a liability, but the law in that country has exempted tax. That person will also be called as what? Liable to tax. Okay. The word liable to tax is important with reference to this point because it is written over here. The assessee should not be liable to tax in another country. If he is liable to tax in another country, then he will not be called as deemed resident. If he is not liable to tax in other countries, then he is deemed resident in India. I hope it is clear to all of you. So these are different categories of residential status under the income tax law for individual. Now, an HUF become resident when the control and the management of HUF is either wholly in India or either partly in India. In either of the case, the HUF will be called as a resident. Okay. Can an HUF also be called as ordinary resident? The answer is yes. An HUF can also be called as ordinary resident. If the Karta is ordinary, then HUF is ordinary. If the Karta is not ordinary, then the HUF is also not ordinary. I hope it is clear to all of you. Next. When a firm will become resident, the firm will become resident, again same like HUF, when it is wholly or partly in India. When the control and management of the firm is wholly in India or partly in India, it will be called as resident in India. Sir, can a firm also be called as ordinary, not ordinary? No. Ordinary, not ordinary is only applicable to individual and HUF. Apart from individual and HUF, all other assessees will be either resident or non-resident. They will not be called as ordinary or not ordinary. Okay. Now coming to some second important part after individual. Individual residential status is very important for exam. After that, company residential status is equally important for exam. When a company will become resident in India, as per section 6 clause 3, if it is an Indian company, then it is always resident. But if it is a foreign company, then also it can become resident if its place of effective management in that year is in India. So if a foreign company which is registered outside India, whose place of effective management in that year is in India, then that company will also be called as a resident in India. Okay. Now, POEM means what? POEM means a place where key management and commercial decisions of the company in substance are taken. If the key management and commercial decisions of the company are taken in India, then it can be said that the POEM of that company is in India. And if the POEM of that company is in India, that company will be called as a resident company. I hope it is clear to all of you. Now, to explain this in a better way, the CBDT has come up with a guideline to explain, to identify whether the POEM of the company is in India or outside India. But this guideline is only applicable if the turnover of the company is greater than 50 crore rupees. If the turnover is not exceeding 50 crore rupees, it is up to 50 crore rupees, then this guideline is not applicable. So remember, this guideline is only applicable for the companies who is crossing this threshold of turnover. Okay. Now this CBDT guideline, this CBDT circular has divided all the companies into two categories. That is one company where active business is outside India. If the active business is outside India, then the poem is outside India. And if the poem is outside India, then the company is non-resident in India. So when it can be said that the company's active business is outside India, it can be said when all the following conditions are fulfilled. When all these 5 conditions are fulfilled, you can say that the active business of the company is outside India. And if the active business of the company is outside India, you can say that the poem of the company is outside India. All the 5 conditions has to be fulfilled. You do not have an excuse on even one of the condition. If all the 5 conditions are fulfilled, poem outside India and you are non-resident. Let's check up all of them one by one. The first condition, the passive income is less than equal to 50% of total income. The passive income should be less than equal to 50% of total income. You will ask me, what is passive income? Passive income includes 2 types of income. Income number 1, where income is from purchase and sale both from associate enterprise. When I purchase from associate enterprise and sell to associate enterprise, that is passive income. But if I purchase from associate, sell to non-associated, that is not passive. When I purchase from non-associated, sell to associate, that also not passive. Both purchase and sales are from the associate enterprise, then it can be called as passive income. Second, royalty is always passive, capital gain is always passive, dividend is always passive, rent is always passive, interest is always passive. Whether I earn from associate enterprise or non-associate enterprise, it doesn't matter here now. Here it matters whether you are buying and selling from associate enterprise. In point number 2, it doesn't matter. One more thing, for banks, interest is not a passive income. So for banking industry, if your foreign company is a banking company, then for bank, interest will be called as an active income. Okay. Now, the second condition is less than 50% of the total assets are situated in India. Now, remember, there is a very fine difference between the 2 points. Here it is less than equal to 50%, but here it is less than, here it is less than, here it is less than. Okay. So in the first point, it is less than equal to 50%, but in the second, third and fourth point, it is less than 50%. So you have to be very careful with this point. Less than 50% of the assets are situated in India. So how you will compute? Whatever assets ka data they have given you, you take the numerator as Indian assets, denominator as total assets. Okay. Now, for that purpose, if there is a depreciable asset, then you will take the average at the beginning and at the end of the year. And if they are non-depreciable assets, you will take what? The book value of the assets. Okay. For depreciable assets, which value has to be taken? You should take the value as per the taxation law. If taxation law data is not given, then you can take the value as per the books of accounts. Okay. Third one, less than 50% of the employees are situated in India. Therefore, your Indian employees has to be what? Less than 50%, or the resident employees has to be less than 50%. So again, they will give you a data. This is the total number of data, say 100 employees, out of which 60 employees are situated in India. Therefore, 40% in India. Therefore, how will you compute the number of employees? You have to take the average of the employees at the beginning and at the end of the year. You have to take the average on 1st April 2023 and 31st March 2024 divided by 2. That will give you. And employees will not only include those employees which are on payroll, but you will also include the employees which are on contractual basis. All those employees which you have taken on contract basis, they will also be, all those personnel which you have taken on contract basis, they should also form part of what? Form part of the employees. Fourth, all the employees which are situated in India and which are resident in India, their payroll expenses, their payroll expense should also be less than 50% of the total expense. Okay. So the employees which are there in point number 3, which are in India, their payroll expense has to be less than 50% of the total payroll expense. Okay. And the last but not least, your majority of the board meeting has to be held outside India. Majority. If there are 10 board meetings, at least 6 has to be held outside India, and board should have the power to take decision outside India. Which kind of decision? Commercial and management decision. If all these conditions are fulfilled, your active business is outside India. And if your active business is outside India, your poem is outside India. Now, one very important thing. So all this data should be of how many years? The government has recommended that this has to be data of average of at least 3 years. That is current year and the last 2 years. Okay. But if you don't have the data of last 3 years, then you can take a shorter period, that is 2 years also, or you can take a further shorter period, that is current year also. So by default, you should take a average of 3 years, that is current year, and last 2 years. But if don't have the data, you can take a shorter period also. I hope it is clear to all of you. Now, let's come to the second category of company. This was the first category of company whose active business was outside India. Let's talk about the second category of company, the companies other than active business outside India. A company whose active business is not outside India, for them, what has to be done? For them, you have to follow a long procedure. Stage 1, identify the person who has the power to make key management and commercial decision. Identify who makes commercial management decision in the company. And second, identify the place where key management and commercial decisions are taken. The decision where it is taken is more important rather than the decision where it is implemented. For example, Mukesh Ambani sitting in Mumbai and taking a decision to implement a plant in Sri Lanka. So Mumbai is relevant. Where it is implemented in Sri Lanka, that is not relevant. Okay. I hope it is clear to all of you. Further, the CBDT has given other guiding principles also. That is, lot of guiding principles are given. Like for example, we need to also identify the location of the board meetings. Where the board of directors are doing their meeting, that can also be the place of effective management. We can also see if the board is delegating some of the authorities to some committees, then we need to see where the members of the committees are based. That can also be called as what? A place of effective management. Then the location of head office can also be place of effective management. Then the residence of the directors can also be important place of effective management. Then the circular resolution or round robin voting, which is done under section 175 of Companies Act 2013. Circular resolution. If any director has the power to pass a circular resolution and take commercial and management decision, then you need to identify where that director sits and take that decision. That place can be place of effective management. Next, location of strategic shareholder, not normal shareholder. Remember, a normal shareholder like you and me holding 10 to 15 or 100 shares will not impact the commercial decisions of the company. Company is not going to ask us to take before taking any commercial decision. Yes, but if the shareholder is a strategic shareholder, the company will definitely ask the strategic shareholder. Therefore, in that case, the location of that strategic shareholder matters to determine the place of effective management. And last but not least, even if all these factors are not sufficient to determine the what POEM, then there are some other secondary factors which are given by the CBDT in this circular. That is, find out the place where substantial activity of the company is taking place, or find out the place where the accounting records of the company are taken place. Okay. Further, the CBDT, after saying all these principles, these are all different kind of principles which are there to identify what the place of effective management. Even after all these things, you have to take all the cases based on facts and circumstances of every case. No single principle given above can be decisive. No single principle can be decisive. You have to look into the matter into great detail, analyze the things in great detail, and then decide whether the POEM is in India or not. Just because one of the principle is getting fulfilled, that does not mean that the foreign company has a POEM in India. Okay, I hope it is clear to all of you. Now, what is the procedure to hold the POEM in India? There is a two-step procedure. First of all, the department, that is the assessing officer, will initiate the proceeding that the company has a POEM in India by taking an approval from Commissioner of Income Tax. And then he will pass an order by taking an approval from a group of 3 commissioners, that is the group of a collegium of 3 commissioners. So while initiating the proceeding, he will take an approval from 1 commissioner, and to conclude the proceeding, he will take an approval from 3 commissioners. Okay. Now, once a company is declared as what? As resident after the POEM. Now, what is the impact of that impact on that company in the current year now? So listen carefully. For that purpose, section 115JH and notification number 29/2018 has been brought by the government of India. So suppose there is a company which was a resident of UK till last year, but in the current year, this company has become what? This company has become resident of India because of the POEM. Now, what will be the impact on this company? The impact on the assets of the company. Will the company get depreciation in India now? Why not? Because now the company is resident in India, therefore global income is taxable in India, therefore the company is liable for what? The company is eligible to claim depreciation under the income tax law. Therefore, now the question will be, what will be the WDV of the company? Because till last year, the company was not resident in India. In current year, the company is becoming resident because of POEM. So what will be the WDV of the company for the purpose of this year? So that for that purpose, we need to identify first of all, whether the foreign company is assessed to tax in the foreign country or not. Whether there is a taxation law in the foreign country, and the answer is yes. Then you have to ask second question, whether the foreign company is allowed depreciation in the foreign country or not. Yes, it is allowed. Then whatever is the WDV as per the tax record, whatever is the WDV on the last day of the financial year of tax record, that will become the WDV on the first day of the current year. Suppose in that country, there is no depreciation allowed to the company. There is a taxation law, but depreciation is not allowed to the assessee. Then we should compute the WDV as per the tax record of that country, and that WDV will become what? The WDV in India. I hope it is clear to all of you. Suppose the foreign company is not assessed to tax in the foreign jurisdiction. Like say in UAE, some of the parts, there is no taxation, there is no income tax in Dubai, etc. Very recently they have introduced, but till last year there was no taxation in Dubai. So suppose this company belongs to Dubai and now they are becoming resident of India. Then how will I compute the WDV? Then you have to compute the WDV as per what? As per the books of account. I hope it is clear to all of you. Let's move on to the second point where there is a lot of debate and disparity. That is, what about the loss of that company which was there in foreign country? Now it has become a resident in India and unabsorbed depreciation of that country. Okay, don't worry. Whatever loss is there as per the taxation law, if taxation law persists, or as per the accounting law, if taxation law does not persist, all the losses, all the UAD will be allowed to be carried forward in the current year for balance number of years. For balance number of years. Okay, only for the balance number of years. You will not be allowed to carry forward that for another 8 years. Okay, if there is a tax record, then as per the taxation law, you can carry forward for the balance number of years. If there is no tax, then as per books of accounts, you can carry forward against the Indian incomes. Okay, now it will be set off against which income? It is only allowed to set off against what? The income which is accrued and received outside India. So that loss which has been incurred outside India, that UAD which has been incurred outside India, that can only be allowed to set off against the income which is accrued outside India and received outside India. That cannot be set off against the Indian income. Be very careful. This is a very important point. Now, after you have taken that loss in India, after you have taken that UAD in India, you have set off that loss in UAD, and suppose in foreign country there is a revision in the laws, there is a change in the laws, there is a change in the UAD, then you also have to make the change in India. Okay, you also have to make a change in India. Now, suppose the foreign country is not following the same financial year as we are following. Suppose the financial year of the foreign country is a calendar year and the financial year in India starts from April to March. Then what shall I do? Now for that purpose, we need to be very careful. Suppose the company has become resident in previous year 23-24 and there in the foreign country they follow calendar year. So you need to be very careful. You need to identify the last financial year of that country. The last financial year is 1st Jan 2022 to 31st December 2022. Okay, that will be the last financial year of that particular country. Okay, now listen carefully. You have to be very careful with this. This is a very tricky point. So suppose, for example, the company has become resident in India in previous year 23-24 and therefore you need to see the last calendar year of that company, and then you have to see the intervening period. If this intervening period is less than 6 months, okay, if this intervening period is less than 6 months, you have to add that period to this last year and you have to make that entire period as one financial year. Okay, and that entire period will be called as one financial year. But if this intervening period is more than 6 months, then this last year will be separate financial year and this more than 6 months period will be called as a separate financial year. For better understanding, I have put an example over here. You can read that. With the help of that example, you will understand very easily. Okay, I hope it is clear to all of you. You just have to see that whichever year you have become resident, see the last financial year of that country. And if in the between period is more than 6 months, then it is an independent financial year. If it is less than 6 months, you have to club with the last financial year. I hope it is clear to all of you. Now, let's move on to the next few aspects which are also very important. This one has been asked in examination once upon a time. Now, listen carefully. Now, this foreign company is a foreign company. Is it a foreign company? The answer is yes. Is it also a resident? The answer is yes. Now, if somebody makes a payment to this foreign company, they will deduct TDS as per what? As per section 195 or as per section 194J, as per section 195 or as per section 194C, because in 195 it is written when you make a payment to foreign company you have to deduct TDS, and in 194J it is written when you make a payment to resident you have to deduct TDS. Now fortunately this company has been a resident also and has been a foreign company also. So as per what I should deduct the TDS? So the law says that you have to deduct TDS as per section 195, assuming that this company is a foreign company and not as per resident. Okay, so you have to deduct TDS as per foreign company and not as per resident. Further, this company has become a resident of India. Now, if this company earns some doubly tax income, whether the government of India will give the relief under section 90 and 91 to this company, the answer is yes. If this company is earning some doubly tax income in 2-3 countries and also earning income in India, then it will be liable for, it will be eligible for and relaxation under section 90 and 91 under the income tax law. Further, now this company is a foreign company, this company is a resident, but this company is not a non-resident. Therefore, all the provisions of foreign company shall apply to this company. All the provisions of resident shall apply to this company. But any provision of non-resident shall not apply to this company, because this company is no more a resident in India now. Last but not least, this company has become a resident in India. Therefore, the question is, what will be the tax rate? Unfortunately, the tax rate will continue to remain at what? At 40% only. We are not going to give them the benefits of the tax rates which are enjoyed by the domestic company. The tax rates will remain at 40%. I hope it is clear to all of you. Let's move on to the next point. Clarification for non-resident seafarers. Suppose if I am an employee and if I am working in an Indian ship, okay, so I am a non-resident seafarer. Now, if I receive any salary in a non-resident external account, if I receive my salary in an NRE account in India, then that is exempt under income tax law. So this exemption is only for non-resident seafarers. If non-resident seafarers receive their salary in the NRE account in India, then that is exempt under the income tax law. Okay. So let's go ahead with the next part, which is a very important part for your examination. That is when an interest income will be accrued in India. First of all, we'll try to understand when the interest income will be accrued in India, and then we'll try to revise the discussion of what is the tax rate of interest income, etc, etc, etc. Okay. So when an interest income is accrued in India, first of all, if it is payable by government, then it is always accrued in India. Okay. Then If it is payable by resident, then also it is accrued in India. But in case of resident, there is an exception that if the resident has taken a loan for the purpose of business and profession outside India or for the purpose of other purposes outside India. So if I have taken a loan, if I use that money outside India, say in Sri Lanka for business and purpose, business and profession, or for other purpose outside India, then it is not deemed to accrue or rise in India. Okay, be very careful. Third one, if it is payable by NR, but if it is payable by NR, then it is always accrued in India only if it is used in India for the purpose of business and profession. Suppose one NR is giving loan to another NR and that money is used in India for the purpose of business, then the interest is accrued in India. What if the NR uses that particular money in India for other purpose? If the NR uses that money in India for other than business purpose, then it is not accrued in India. So one NR is giving loan to another NR and another NR is using that money in India for other purpose, then it is not deemed to accrue or arise in India. Be very careful. Okay. Apart from that, suppose you have an NRE account in India, NRE account in any bank in India, and you are receiving some interest in that NRE account, then that interest is exempt to non-residents. Which non-residents? Any person who is a non-resident as per the FEMA law or as per the RBI law. Okay. So if you are a non-resident as per the FEMA law, and if you have maintained an NRE account, non-resident external account in India, in external account, if you are receiving some interest, then that interest is also exempt under section 10(4)(2). Okay. Now let's come to the next point, that is when royalty and FTS will be chargeable to tax in India, when royalty and FTS will be deemed to accrue or arise in India. Now for that purpose, the first point and the second point is exactly same like interest only. Okay. So if the royalty is payable by government, it is deemed to accrue or arise in India. If the royalty is payable by resident, it is deemed to accrue or arise in India. But if the royalty, if the services which is taken by the resident is used outside India for the purpose of business, profession or other purpose, then it is not deemed to accrue or rise in India. The third point is different as compared to interest. If the royalty is payable by non-resident to another non-resident, then it is deemed to accrue or rise in India. If the services are utilized for the purpose of business and profession in India or for the purpose of any other purpose in India. Okay. So this any other purpose was not there in interest. This any other purpose is even taxable here, which was not taxable in interest. So this is the difference between interest and royalty and FTS. I hope it is clear to all of you. Now, there is one very important explanation which is given below section 9 under the income tax law, that is with respect to royalty, interest and FTS. Generally, if the government wants to charge a PGBP income of a non-resident in India, then the non-resident should have a business connection in India or the non-resident should have a permanent establishment in India, some presence in India. But for these three incomes, interest, royalty and FTS, there is no need to have any presence in India. There is no need to have any business connection in India. These three incomes are taxable the moment the services are utilized in India. There is no need to have a permanent establishment or business connection in India. Further, it is not relevant that these non-residents to tax these incomes in India, the services should be rendered in India. The services may be rendered outside India, but the services should be utilized in India. Utilization of services in India is important. Where the services are rendered, that is not important in these cases. Now, we are going to learn the tax rates of interest, royalty and FTS. First of all, we are going to learn the tax rates of interest, and then we are going to learn the tax rates of dividends, and then we'll talk about the tax rates of royalty and FTS, in which there are some Finance Act 2023 amendment also. So let me talk about, there are various categories of interest over here. There are 4 categories of interest which are covered under section 115A. 115 is a special tax rate covered under chapter 12, only applicable to interest, dividend, royalty and FTS. So let us talk about interest first. In the very first section, in the very first interest, the lender is non-resident and foreign company, the borrower is Indian concern and government, and the rate of TDS will be 20%. The interest will be taxed at 20%. Time limit, there is no time limit. Even today you can get the benefit, approval, and there is no need to take any approval from anybody, but the loan has to be in foreign currency. You have to be very careful with the first section. If you want to get covered in the first section, the loan has to be in the foreign currency. Let's move on to the second section. In the second section, the lender is non-resident and foreign company, same as the first one, and it is lending the money to infrastructure debt fund. So the borrower is infrastructure debt fund. The tax rate over here in the hands of the non-resident in respect of interest will be 5%. TDS will be deducted under section 194 LB. There is no time limit. There is no approval required. Plus, here there is one advantage that the loan can be in any currency. There is no need that the loan should be in foreign currency. Okay, I hope it is clear to all of you. The third section is the biggest out of all the interest. First one is simple, second is simple, third one is slightly tricky because there are multiple instruments which are covered in the third section. The third section, very important. Non-resident foreign company is the lender, and who is the borrower? The borrower is Indian company. Now here there are multiple rates. In some cases it is 5% tax rate, in some cases it is 4%, and in some cases it is 9%. The TDS will be deducted under 194 LC. Now let's see when 5%, when 4%, when 9%, and let's see which all instruments are covered over here. there are a lot of things to be seen over here. Okay. Now the very first thing, there is a time limit to borrow the money. Only if you borrow the money between this period, then this section is applicable. Otherwise, this section is not applicable. What is the time limit? If the money is borrowed after 30th June 2012, but before 1st July 2023. So if you borrow on or after 1st July 2023, this section is not applicable. This section is only applicable if you borrow before 1st July 23. Then the tax rate is 4% and 5% in some cases. Okay. The rates I will discuss in a while. Don't worry. If you borrow after 1st July 2023, in some cases it is 9%. It should be approved by central government. I'll tell you all the cases. Don't worry about it. Okay. There is no need to, this point also I will address you in a while. Now, what is covered in this section? Let me talk about the instrument. Let me talk about the loans and the long-term bonds. If you purchase, if the non-resident or foreign company buys, gives loan to Indian company or buys the long-term bonds of Indian company in foreign currency. Okay. So this is the first thing which is covered over here. And now listen, if the non-resident and foreign company gives loan to Indian company, or if the non-resident foreign company buys the long-term bonds of Indian company in foreign currency, and if it is done on or after 30th June 2012, but before 1st July 2023, then the tax rate will be just 5%. Okay. How much? Only 5%. Next, if they buy what? Rupee denominated bond in any currency. For rupee denominated bond, there is no restriction. Either it can be foreign currency, it can be Indian currency. If they buy rupee denominated bonds in any currency, then they will be liable for tax what? At 5%. Okay. So 5% in all these three cases: loans, long-term bonds in foreign currency, and rupee denominated bond in any currency, it is 5%. Okay. Now, when it is 4%, let me tell you, it is 4% in a very specific case. If the money is borrowed by way of long-term bond or rupee denominated bond after 2020, but before 2023, which are the bonds which are listed on a recognized stock exchange. Okay. If the bonds are what? Listed on a recognized stock exchange in IFSC, then the tax rate is 4%. Okay. And if this same bond or if this same rupee denominated bond is listed on a recognized stock exchange, and if you borrow after 1st July 2023, then it is 9%. So generally the tax rate in this section is 5%. But if you borrow the money through long-term bonds or rupee denominated bond in an IFSC, if it is before 1st July 2023, then it is 4%. If it is on after 1st July 2023, then it is 9%. This is how these three rates are mentioned over here. Now, there is one relaxation also for rupee denominated bonds. That is, the relaxation is as follows. If the rupee denominated bonds are issued between this date, listen, see carefully. If the rupee denominated bonds are issued between 17 September 2018 to 31st March 2019, if it is issued between this period, then it is exempt under income tax law. It is not liable to tax. I hope it is clear to all of you. These are different kind of varieties which are covered under section 194 LC and this third interest under this section. Okay. Now the fourth interest. In the fourth interest, who is the lender? FII and QFIs are the interests which are approved by the SEBI. They will lend money to whom? They will lend money to Indian company or they will lend money to the government of India. They will lend money to Indian company or to the government. What is the tax rate? The tax rate over here is 5% and the TDS over here will be deducted under section 194 LD. Here also there is some time limit. What is the time limit? The interest has to be payable. Your money should not be borrowed. Your interest has to be payable after 31st March 2013 to 1st July 2023. Before 1st July 2023. So the interest has to be payable between this period. Now what has to be bought? What not the FII and QFI will buy? The FII and QFI will buy the rupee denominated bond, government security and the municipal debt securities. These are the three items that the FIIs can buy over here. They will be liable for 5% tax rate, 194 LB. Now in both these sections, that is the third and the fourth section, the government will approve the interest rate. You cannot pay interest more than the government rate approved. If you pay more than what the government has approved, you are not going to get the benefit of these sections. Okay. And one last thing over here is, if any non-resident is lending money to a unit of an IFSC on or after 1st September 2019, so if there is a non-resident who is lending money to a unit of an IFSC and the unit of an IFSC is paying interest to that non-resident, then it is exempt under section 1015. There is no need to pay tax on that particular amount. Okay. And one last thing, what is the tax rate of dividend income over here? The tax rate of dividend income over here is, in case of normal cases, it is 20%. In case of special case, what is a special case? Special case is, so what is special case over here? If the dividend is received from a unit of an IFSC, then it is subject to only 10%. This is an amendment made by Finance Act 2023. So remember, if a non-resident or foreign company earns dividend, generally it is taxable at 20%. But if it is received from a unit of IFSC, then it will be taxable only at 10%. Now, whether I'm going to get any PGBP deduction? No PGBP deduction will be allowed. No IFRS deductions will be allowed. Yes, unabsorbed depreciation will also not be allowed. Okay, these three things will not be allowed to you. Whether Chapter 6A will be allowed? No Chapter 6A will be allowed. Only one Chapter 6A is allowed. That is 80LA. Only ATLA is allowed, no other chapter 6A will be allowed. Okay, whether there is any, if there is any other business loss, can I set off that business loss with this income? Yes, I can set off the business loss with this income. That is allowed. Don't worry about it. Is the non-resident supposed to file the income tax return? The non-resident is not supposed to file the income tax return if the non-resident only earn this special income, and the TDS is deducted at a rate not less than the rate specified in 115A. So if the TDS is deducted at the rate specified in 115A and the only income is this interest income or dividend income, then the non-resident is not liable to file the income tax return. Okay. Last but not least, is the non-resident liable to MAT? The non-resident is not liable to MAT if the normal rate is less than 15%. Wherever the tax rate of the non-resident is less than 15%, there is no need to pay any MAT liability on that. The provisions of MAT will not apply. But yes, if the normal tax rate is more than 15%, then you will be liable for MAT under the income tax law. I hope it is clear to all of you. Okay. Now let's move on to the next one. This completes the 115A interest part. Let's move on to the next part of 115A, that is royalty and FTS. Now, if there is a non-resident or a foreign company who is giving some services to government or to an Indian concern, then they will be liable to tax at 20% or DTAA, whichever is lower. Now, this is an amendment made by Finance Act 2023. Earlier, it was 10% or DTAA, whichever is lower. Now, it is 20% or DTAA, whichever is lower. Okay. Now, no, again, here also, no MAT liability if your normal tax rate is less than 15%. So, if your normal tax rate is less than 15%, for example, if it is mentioned in DTAA that it is taxed at 10%, then you will be liable to pay tax at 10%. So, now your normal rate is 10%, which is less than the MAT rate 15%. Therefore, you will be liable for MAT. But if you are paying the normal tax at 20%, then you are not liable for MAT. I hope it is clear to all of you. One very important thing you have to keep it in mind. If you want to come in 115A, there are a few things to be kept in mind. The non-resident should not have a PE in India. If there is a PE in India of the non-resident, then the non-resident will go to 44DA. If the non-resident does not have a PE in India, it will come in 115A. Plus, there has to be an agreement which has been signed by the non-resident and which has to be approved by the central government. Unless there is an agreement which is approved by central government, you cannot come in 115A. Okay, I hope it is clear to all of you. Next one, whether any PGBP deduction will be allowed? No PGBP deduction, no IFOS deduction. Whether I can set off the loss? That loss can be set off against the income. There is no worry about it. Okay, the loss can be set off against the income. Whether the assessee is liable to file the income tax return? Again, only if this income is earned and the TDS is deducted at least at the rate mentioned in 115A. What is the rate mentioned in 115A? 20%. If TDS is deducted at 20%, no need to file ROI. But if the TDS is deducted at lower than 20%, that is as per DTAA, suppose if the rate is 15% and TDS is deducted at 15%, then the assessee is liable to file the income tax return. I hope it is clear to all of you. Whether the chapter 6A deductions will be allowed? Yes, chapter 6A deductions are allowed over here. Against interest, it was not allowed. Against interest, only one chapter 6A was allowed. That is ATLA. But here you can claim all chapter 6A deductions. No worry about it. Okay. And last but not least, there is one exemption given to certain people. If a non-resident or foreign company provides some services to National Technical Research Organization, if the non-resident or foreign company provides some services to National Technical Research Organization, then the royalty and FTS is exempt under the income tax law. Okay, I hope it is clear to all of you, which is exempt under section 10 clause 6D. Last but not least, there are some explanations which are attached below the definition of royalty. That is, if somebody is providing you some services with respect to computer software. Now, there is a lot of debate over here. You have to be very careful with this. If somebody is giving you the right to use a computer software, what they are giving you, if they are giving you a right to use a computer software, then in that case, it is a royalty, and the royalty TDS will be deducted under section 195, sorry. Okay. Therefore, you have to be very careful. There are two ways in which somebody can give you computer software. Suppose if company is giving you computer software to make computer software, okay, they are giving me the right to use computer software. So I'm taking the right of that computer software and I'm making computer software and selling it. Now, when I'm paying the money to that company, that is royalty, okay, and therefore that is not my asset, that is an expense, and therefore that will not be added to the block of asset. That is a revenue expenditure. I will claim deduction subject to deduction of TDS. Okay, I will claim deduction under section 37 subject to deduction of TDS. But the Supreme Court of India, in the case of Engineering Analysis Center of Excellence Private Limited versus Commissioner of Income Tax and other, has held that when you buy a computer software as an end user or for resale, so if you buy that as an end user or for resale, then in that case it is not a royalty. And if it is not a royalty, then it will be called as what? Please tell me. It will be called as what? It will be called as an outright purchase. Therefore, it will not be considered as a royalty. I hope it is. And then you will not deduct TDS under section 195. So you have to be very careful with these 2 points. Okay. When you buy a right to use a computer software, that is a royalty. But when you buy a software to sell to someone as a retailer or for end user of yourself, then you are not paying any royalty for that. Then that is an outright purchase. Then therefore that cannot be called as a royalty. I hope it is clear to all of you. Next one. Next one is also a specific explanation under the definition of royalty. So you have to be very careful with that. This has come for banking industry. Suppose there is a bank, that is SBI over here, and SBI has issuing some credit card to the customers. Okay. Now there is a Bank of Germany over here who is providing server to the SBI, because every time a customer will go to the shop and swipe the card will go for approval, and for approval there needs to be server, and the server belongs to Bank of Germany. So at the end of the day, Bank of Germany raises invoice on SBI and SBI pays some money to them. So whether that will be royalty, the answer is yes. That will also be royalty under the income tax law. That is what it is given over here in explanation 5 to section 9. Third one is for TV channels. Suppose there is a TV channel over here, say for example Zee TV, and suppose now Zee TV wants to transmit the programs on television. So for that purpose it wants to use the satellite of foreign company. Now the foreign companies is allowing Zee TV to satellite to transmit their programs. So at the end of the year, the foreign company will charge some money to Zee TV because they are using the satellite of that foreign company. So whatever money Zee TV is paying to that foreign company, that will also be royalty under the income tax law. Check it please. Under section 195, you are supposed to deduct the TDS. Now, as I've told you, 115A is applicable only if the non-resident does not have a P in India. What if the non-resident has a P in India and there is an agreement between both of them which is approved by central government? Then in that case, you have to follow 44DA. So let's compare both of them. 115A is applicable if there is no PE, and 44DA is applicable if there is a PE. Now, if 115A is applicable, you do not get deduction of any expenses because you don't have any permanent establishment in India. You are not making any PL in India. You are not making any profit and loss account in India. How will you get the deduction? But if you are following 44AD, you will be allowed all the expenses, but some expenses are restricted. Like, very important. If an expense is not wholly for Indian branch, it will not be allowed as deduction. Therefore, the expense has to be wholly for the Indian branch. If it is not wholly for Indian branch, it is partly for Indian branch, partly for foreign branch or foreign HO, then it will not be allowed as deduction. Second. If an expense is paid to HO for services taken from HO, it will not be allowed as deduction because it is payment to self. If HO is giving me some services, I am making some payment to HO, it will not be allowed as deduction. Okay. And third one. If HO is not giving the service is given by some third party and HO has made the payment to them and I am making the reimbursement payment to HO, then that reimbursement payment will be allowed because in that case it is not payment to self, it is payment to third party. Okay. Chapter 6 deductions will be allowed in both the section in 115A as well as 44DA. Losses of other business will be allowed in both the sections. In 115A, there is no need to maintain books of accounts. Here you have to maintain books of accounts. In 115A, there is no need to do audit. Here you have to conduct audit and make an audit report. In 115A, the tax rate was 20% or DTAA, whichever is lower. Here the tax rate will be normal tax rate. For foreign company, it will be 40%. For others, it will be normal rates. Okay. I hope it is clear to all of you. Here we complete all the discussion of what? All the discussion of interest, dividend, royalty and FTS. Now let's move on to the next part. That is a very small part, not very important for examination. Once upon a time, it has come once in the examination in 2016. Now let me explain you that with the help of example. There is a Bank of America Indian branch over here, and there is a Bank of America headquarters over here, and there is a Bank of America Singapore branch over here. Now this Bank of America headquarters is giving loan to the Indian branch, and in return they are paying interest. Now this Bank of America is getting deduction over here of the interest. Therefore the law says that because the Bank of America Indian branch gets deduction of this interest should also be taxable in the hands of Bank of America headquarters. Principle of equality. If you are claiming deduction over here, then you should also claim that as a income over here, and therefore this Indian branch is liable to deduct TDS on this. If they don't deduct the TDS on this, they will be liable for what? Interest and penalty for non-deduction of TDS. This is what this point wants to tell us. Okay. Nothing great apart from this. Now, there are 3 more special sections which are going to come one by one now. Let me address all of them one by one to all of you. Okay. The very first special section is 115AB. In this, who is there? In this, overseas financial organization is there. Who is an overseas financial organization? It's a non-resident organization who has taken an approval from SEBI to invest in India. Okay. So they have an approval from SEBI to invest in India. Where they are investing? They are buying units of UTI. They are buying units of mutual fund which is purchased in what? Foreign currency. Okay. They are buying units of UTI, units of mutual fund which is purchased in foreign currency. Now whatever long-term capital gain they will earn, they will be liable for 10% tax under section 196B. And now, whether they will get any deduction? No deduction under chapter 6A, under PGBP, etc. First proviso to 48 not applicable. Second proviso to 48 not applicable. What is first proviso to 48? That TTBR, TTSR calculation. What is second proviso to 48? Indexation. Even indexation benefit is not allowed. Whether set off of loss is allowed? Yes. If there is some other long-term capital loss or short-term capital loss, you can set off against this income. Exemption from filing ROI? No. You have to file the ROI. there is no exemption from filing of ROI. ROI has to be filed by the assessee. Now, coming to the second section, which is very, very, very important. Non-resident and foreign company is there under 115 AC, who is the lender. What are they are lending? To whom they are lending? They are buying the bonds of Indian company, or they are buying the bonds of public sector company, or they are buying the global depository receipts. All of them they are buying in foreign currency. Okay, so if the non-resident or foreign company buying these things in foreign currency, you will be covered under this section 115 AC. LTCG will be taxable at 10%. STCG will be taxable normally the way it is taxed to others. Interest and dividend will also be taxable at 10%. Rest everything is same except the last point, that is exemption from filing ROI. Yes, if they only earn interest income and TDS is deducted, there is no need to file ROI. In the first case, there is no exemption. It means in the first case you have to file the ROI. In the second case, there is some relaxation from filing of ROI. Okay, now coming to the third section. Third section is 115 AD, and there are multiple tax rates over here. Who is the assessee over here? The assessee is specified fund, which is covered under 10(4)(d), which we have already done in capital gains revision. Go and check over there. And FIIs. So FIIs and specified funds, these are the two categories of people who are there over here. Okay. Now, what are they going to do? They are going to buy security other than 115 AB. Other than 115 AB, they can buy any security in any currency. Okay. In any currency, they can buy any security. Now, what is the long-term capital gain? The long-term capital gain, there are multiple rates. The normal long-term capital gains will be taxed at 10%. The normal short-term capital gains will be taxed at 30%. But the special capital gains under 111A will be taxed at 111A rate 15%. And the 112A capital gains will be taxed at 112A rate 10% at in excess of 1 lakh rupees. I hope it is clear to all of you. So all the four capital gains rates are mentioned over here. Okay. 111A will be taxed at 111A, 112A will be taxed at 112A, 10% subject to 1 lakh, and normal LTCG 10%, normal STCG 30%. What about dividend and interest? The recurring income, the dividend and interest for FII it is 20%, for specified fund it is 10%. But if the interest is the one which is covered in 194 LD, because in 194 LD FII is also there. FII is there at two places. FII is there in this section also, in 194 LD also. So in case of 194 LD case, the FII will be taxable at 194 LD rate only, that is 5% only. Okay. Rest all is same as the first section, as you mentioned, as you can see over here. That is one more thing which you need to keep in mind over here. And that one more thing is, pay attention please. In this section, that is in 115 AD, you want the relaxation of these rates. Yes, I want the relaxation of these rates, and for that purpose, what are you supposed to do? All the unit holders has to be non-resident. If all the unit holders are not non-residents, then you will get relaxation only on the proportionate income. Suppose there are 100 unit holders, out of which 70 unit holders are non-resident. Therefore, 70% of the income will be chargeable at this rate I mentioned in 115 AD, and 30% of the income will be taxable at normal rate, which is applicable to normal assessees. I hope it is clear to all of you. Now let's move on with the next part. The next part is the continuation of the section which we have just done, that is 115 AC. If you see over here in 115 AC, there is one point, that is global depository receipt. Now we are going to talk about the global depository receipt taxability. Okay. So what is the global depository taxability under the income tax law? First of all, what is global depository receipts? Income tax only recognize global depository receipts of a listed company. They do not recognize global depository receipts of an unlisted company. Okay. This is the first thing that you have to keep it in mind. Now, what is global depository receipt? Suppose there is a listed company in India by the name called as Infosys. Okay. Now, if Infosys wants to raise money outside India, then they have to raise the money through GDR. They have to appoint one local bank, local depository in UK, and that local depository will issue GDRs to the residents of UK. Okay. So now, suppose the Infosys has given some kind of GDR to the residents in UK. Now, if that GDR is sold by one non-resident to another non-resident, which GDR? The GDR of Infosys. Infosys is a listed company. So, if a GDR of a listed company is sold by one NR to another NR, then it is exempt under section 47(7)(a). Okay. It is not taxable. It is exempt transfer under section 47(7)(a). This is tax implication number one. Okay. Now, suppose the non-resident has purchased 100 GDR of rupees 1000 each on 15th of April 2023. Okay. Now, Mr. A, who is a non-resident who has purchased. Now, if he sell this GDR to another non-resident, then it is exempt. No capital gains will be chargeable. But he doesn't want to sell. He wants to trade in the Indian market. Now, in the Indian market, we cannot trade on GDR. In the Indian market, if we want to trade, the non-resident has to buy the equity shares of the Indian company. Okay. So now the non-resident is requesting what? Infosys that convert this GDR into what? Convert this GDR into shares of Infosys. So now he has requested, he has made a request for redemption on 15 September. On that date, value of one share of equity shares of Infosys was 2,200 rupees. Okay. Now, what is happening? I'm making a request. After that, Infosys is fulfilling that request. And on 15th of November, Infosys is giving me 50 shares. In exchange of what? In exchange of 100 shares. whether it will be a taxable transfer or not. I am giving GDR, taking shares. Yes, it is a taxable transfer because exchange also amounts to transfer. So how will the capital gains be chargeable now? The capital gains will be sale consideration. Whatever you have received, you have to take the market value of that. What you have received? You have received 50 shares. Which date's market value? The date on which I made the request or the date on which I got the shares? The law says that you should take the market value of the date on which you made the request. The date on which I made the request, the market value on that date was 2,200 rupees. So 2,200 into 50 shares, this will be my sale consideration. What is my cost? My cost is very straightforward. 100 GDR into 1,000 rupees per GDR. 1 lakh rupees is my cost, and therefore the differential amount will be my short-term capital gains because it is sold for, it is converted in approximately 4 to 5 months. Okay. Now, what do I have? Tax implication number 3. As a shareholder, what do I have? Now I have 50 shares of Infosys. Now whenever I will sell these shares, I'll be liable for capital gains. Okay. Suppose I sell these 50 shares for 3,000 rupees. So I will be liable for capital gains. Now again, a question will arise. Two questions will arise. Whenever you compute any capital gains, there are always two questions which are arise. One, what is the period of holding? So the law says that the period of holding will be counted from the date on which the request for redemption was made. That is, the period of holding will also be counted from the date of request for redemption. And second, what will be the cost of acquisition of these shares? The cost of acquisition of these shares will also be the FMV on the date on which the request for redemption was made. That is, it will be 2,200 rupees. Entire discussion is given very beautifully in the form of an example so that you can easily understand with the help of this example. Okay, I have told all the provision to you all. Now coming to the next part, which is a very, very, very important section for your CA final examination from this chapter. That is the provisions of chapter 12A, which is covered under section 115C2I and which is applicable to non-resident Indians. Now this is altogether a different chapter in itself. This is altogether a complete chapter in itself, and therefore there are multiple parts of this chapter. First of all, there is definition, then method of computation, then tax rate, so on and so forth. So first of all, we will try to understand the definitions of this chapter. Who is an NRI? An NRI means an individual who is either a citizen of India or a person of Indian origin. Either of the two will be okay. Okay. Plus, as per income tax law, that person is non-resident. Now, what that NRI is purchasing? That NRI is purchasing some assets in foreign currency. Be very careful. He is purchasing 4 types of assets in foreign currency. First, shares of Indian company, private, public, both the shares will be covered, but he should purchase in foreign currency. Debentures of only public, debentures of private company not covered. Deposits of only public company, deposits of private company not covered. Government security. Shares of both the companies covered, but debentures and deposits of only public companies covered. He should buy this in foreign currency. Okay. Then only this section is applicable. Foreign exchange asset will be applicable. Otherwise, if he buys in Indian currency, this section is not applicable. Then which incomes are covered over here? LTCG from these assets are covered, and interest and dividend income from these assets are covered under this section, which will be taxed at a relaxed rate, which will be taxed at a optional rate. But you are not going to get any deduction of PGPP, IFOS or chapter 6A. All these things are not available. Whether first provision to 48 is available? Yes, first provision to 48 is available. It means you will be liable for what? You will be liable to do that calculation of TTBR, TTSR, etc. when you make the capital gains calculation. Second provision not applicable. It means you are not liable for, you are not eligible for indexation. Other incomes will be charged at normal rate. Now coming to important point. What will be the tax rate of LTCG? Tax rate of LTCG will be 10%. All kind of LTCG will be subject to 10% tax rate. What will be the tax rate of interest income and dividend income? It will be taxable at 20%. Other incomes will be taxable at 20%. Other income will be taxable at normal rates. Now, one of the biggest advantage of opting for this chapter, because this chapter is an optional chapter. It's not a mandatory chapter. It's an optional chapter. See, 115I says that this is an optional chapter. It is not a mandatory chapter. If you want to opt, you can opt. If you don't want to opt, don't opt. That is absolutely your choice. Okay. Now, what is one of the biggest advantage of this chapter? One of the biggest advantage of opting this chapter is once you sell the asset, and if there is a long-term capital gains, and within 6 months from the date of transfer, if you invest the net consideration, not gain, the entire net consideration, if you invest in the specified asset, then your entire capital gains will be exempt. But if you do not invest the entire net consideration, then proportionate capital gains will be exempt, just like 54F of capital gains. Okay. So you should invest the entire net consideration, not capital gains, entire net consideration. If you don't invest the entire net consideration, then proportionate capital gains will be exempt. Plus the new asset which you will purchase, it has to be retained for a period of 3 years. If you sell that within 3 years, then the old exemption which was given to you, that will also be withdrawn, and capital gains will also be chargeable on the new asset which is transferred. Okay, just like the way you do in capital gains chapter. Okay, now am I supposed to file the ROI? There is no need to file ROI if the assessee only earns these incomes and the return is also, and the TDS is also deducted. There is no need to file ROI. What if the assessee becomes non-resident? Assessee becomes resident in subsequent year. No harm. Even if the assessee becomes resident in the subsequent year, assessee will continue to enjoy the benefits of this chapter till the time the asset is there with the assessee. Don't worry about it. Okay. Now coming to some next part, which is not exclusively applicable to non-resident. It is applicable to everybody. That is 115BB. That is a special tax rate for 30% tax rate from lottery, crossword puzzle, including horse race, card games, etc. except online games. Now, online games is not covered in 115BB. Online games is specifically covered under a new section from Finance Act 2023, that is 115BBJ. So, online games will be taxable at 30% under section 115BBJ and not under section 115BB. This is not exclusively to non-resident. These two sections are applicable to everybody. That is the reason we have kept over here. For resident, non-resident, for everyone, the section is going to be charging the same tax rate only and the same way of mechanism. Okay. Now, let's talk about certain exemption of non-resident. What are the exemptions for non-resident which are covered under section 10? We are not going to cover all the exemptions of assessees. We are only going to cover the non-resident exemptions because this chapter is of non-resident. Okay. So let's talk about the very first thing, that is section 1048. What is 1048? 1048 gives exemption to foreign company. What does the foreign company has to do? They have to sell crude oil or other notified goods and services which are notified by government. They have to sell to whom? They have to sell the goods for crude oil to any person in India. Okay. And they have to receive the money in India. They have to receive the money in INR. They cannot receive in foreign currency. They cannot receive outside India. They should not be engaged in any other activity in India. If they fulfill all these conditions, they should also enter into an agreement with central government, and there is a national interest to enter into an agreement. If all these conditions are fulfilled, whatever income is earned by the foreign company from sale of crude oil, that will be exempt under the income tax law under section 1048. Plus even MAT will not be liable because for section 10 income, MAT is never applicable. I hope it is clear to all of you. Now what is 1048A? How 1048A is different from section 1048? Let's see. A foreign company is now storing crude oil in India. What are they doing? They are storing crude oil in India and then selling from there. Here in the first section, they were not storing. But in the second section, they are storing crude oil and then they are selling the crude oil in India. Now they are selling to whom? In the first section, they were selling to any person in India. But here in second section, they have to sell to residents in India. They cannot sell to any person in India. In the first section, it has to be received in India in INR. In the second section, there is no condition like that. You just have to accrue that income in India. There is no need to receive in India or receive in INR. They can receive outside India. They can receive other than INR also. In the first section, they cannot engage in any other activity. There is no condition like this over here. And the last point is similar to the first section. Okay. I hope you are clear with the distinction between both the section. Now, the second and the third section is third and the fourth section, is a continuation of the second section. Okay. Now, suppose there is an agreement between the non-resident and the government of India. Okay. That we are foreign company and the government of India that we will store in India and we will sell for 5 years. Okay. Now, suppose the agreement is expired and there is some leftover stock. There is some leftover stock. So, after the agreement is expired and if they sell some leftover stock, whether that income will also be exempt, the law says that yes, even that income will be exempt under section 1048B. Further, they have one question. Suppose there is an agreement which is not expired, but which is terminated by both the party in between only. The agreement is of 5 years, but we are terminating after 2 years. Whether that will also be, and if once we terminate and then we sell the crude oil, whether that will also be exempt? Yes, that will also be exempt under section 1048B. So even if the agreement is expired and if you sell after that, or even if the agreement is terminated and if you sell after that, then that is also exempt under the income tax law. I hope it is clear to all of you. Now, next few sections are slightly technical in nature. I don't think so. They are very, very important for examination, but nevertheless, it is our duty to revise all of them. We have done all of them in class. So here also we are going to revise all of them. Section 10(4)(e). It is applicable to what? Any income which exempt income will be what? Any income accrued or arisen to a non-resident. How the non-resident is earning an income? As a result of transfer of non-deliverable forward contract. So non-resident is transferring non-deliverable forward contract, or he is transferring offshore derivative or over-the-counter derivative. Or if the non-resident is getting some income out of offshore derivative, they are entering into all this contract with whom? They are entering into all this contract with an offshore banking unit of IFSC, which has commenced operation on or before 31st March 2024. So who is the assessee over here? Obviously, this chapter is of non-resident, therefore the assessee is non-resident. Assessee is accruing some income from what? From transfer of non-deliverable forward contract, offshore derivative, or over-the-counter derivative. The assessee has entered into these transactions with whom? Assessee has entered into this transaction with the offshore banking unit of IFSC. Okay. Now, so all these incomes will be exempt under the income tax law. Now, they have said that we will prescribe some conditions. What are the prescribed conditions? So, for that purpose, they have brought one rule, Rule 21AK, in which they have prescribed some conditions. The above four instrument is entered into with an offshore banking unit which has a valid certificate of registration. So, the entity with whom you are entering into a registration, that is this offshore banking unit, they should have a valid registration certificate, and and such contract or instrument or derivative is not entered into by NR through or on behalf of its PE. So this contract is not entered by any non-resident who has a PE in India. So if the non-resident has a PE in India and if that PE is entering into a contract, then this exemption will not be available to you. I hope it is easily clear to all of you. Okay. Now next one. Pay attention please all of you. Be very careful. Section 10(4)(f). 4E is done. Now 4F. These are very technical points, not very important for exam. Personally, I don't think so. These are very important, but still we have to go through it. Exempt income is any income of NR by way of royalty or interest. So what is the nature of income which is earned by NR over here? Royalty and interest. How are they earning royalty and interest? By leasing of aircraft of ship by a unit of an IFSC. So if a unit of it, they are leasing to whom? By a unit of an IFSC. Any income by royalty or interest on account of lease of aircraft in a previous year paid by unit of an IFSC. So I am a unit of an IFSC. You are a non-resident. You have leased me what? An aircraft. Or you have leased me what? A ship. And I am paying you royalty and I am paying you what? Interest. In that case, that is not subject to tax under the income tax law. I hope it is clear to all of you. You will not be liable to tax. So if you lease these items to a unit of an IFSC and in return if a unit of an IFSC pays you interest or royalty, that will not be subject to tax. Third one. Any income received by non-resident. So there is a non-resident outside India. Say a non-resident is residing in UK and he is receiving some income from portfolio of security, financial product or managed or administered by portfolio manager on behalf of such non-resident. Okay. So a non-resident is there outside India and a portfolio manager is there in India. Who is that portfolio manager? The portfolio manager is an offshore banking unit of an IFSC. Okay. So that is the non-resident who is outside India and the portfolio manager is in IFSC who is an offshore banking unit of an IFSC. So offshore banking unit of an IFSC manages a portfolio of non-resident and whatever income they earn over here, that will not be taxable in India, provided the portfolio manager is trading outside India. If the portfolio manager is trading in BSC, then the non-resident will be liable to tax. But if the portfolio manager is trading in NASDAQ, then it will not be liable to tax. This is what this last line wants to say. To the extent such income accrues or arise outside India. So if the income accrues or arise outside India, just because the portfolio manager is there in India, they will not be liable to tax in India. I hope it is clear to all of you. Plus, in this section, the Finance Act 2023 has made an amendment. They will add some more activities which will be notified by central government. So far they have not added any activity. So thankfully, as of now, there is nothing over here. Okay. Now, the next provision is what? Again, an exemption under section 10, which is for capital gains now. Capital gain exemption to a unit of an IFSC. What are the conditions? The assessee, the transfer is a non-resident. Who is a transferor? If I am transferring something, I should be a non-resident or I should be a unit of an IFSC engaged primarily in the business of leasing of aircraft. So I should be a non-resident or unit of IFSC and we should be engaged in what? Leasing of an aircraft. Okay. Now, the aforesaid transfer generate capital gains from transfer of equity shares in a domestic company engaged primarily in the business of the lease of an aircraft which has commenced operations on or before 31st March 2026. Then for 10 years, my capital gains will be exempt. Okay. So who is the transferor? A non-resident is a transferor or a unit of an IFSC is a transferor. What are we doing? We are engaged in the business of leasing of aircraft. Now, in this case, if I generate capital gains from transfer of equity shares of a domestic company, what kind of domestic company? Which is engaged again in business of leasing of aircraft. So if I am selling the shares of a company which is engaged in the business of leasing of aircraft, my capital gains will be exempt for 10 years. Okay. For 10 years, I will not be liable for capital gains. This is what it has to say. Now, the next point we have already done with the discussion of capital gains. That is under the chapter of capital gains under section 47, specified fund, etc., resultant fund, original fund. We have done this discussion earlier. You can go and check over there. Okay. Now, the next section is absolutely important. This one is very important for examination. Okay. Now, the previous section 10 exemptions, I don't think so are very important for exam, but this one is very important. The next one is also important. Let's talk about this one. This is a remuneration received by an individual. Suppose there is a US embassy in India, okay, in which there is a person who is working, who is not a citizen of India. First of all, that person who is working in US embassy in India, he should not be a citizen of India. Okay. Now, if he is receiving some remuneration from his country, the US government is giving him some remuneration, that will be exempt. The person should be not a citizen of India. One of the important criteria to claim exemption is that now that person of US citizen, that US embassy employee should be not a citizen of India. I am saying again and again. Okay. Now that remuneration received by that US citizen who is in India, who is not a citizen of India, who is a US citizen, then his remuneration will be exempt subject to few conditions. First, he should represent his country in India and the remuneration which is paid by Indian government to Indian embassy in US
should also be exempt. So if you exempt, we will exempt. If you tax, we will also tax. Secondly, the officer which is there in India should not be engaged in any business in India, any profession in India, or any kind of employment in India. So that officer should not be doing any business in India, any profession in India, or any employment in India. If these two conditions are fulfilled, the US citizen employee who is working in US embassy in India will not be liable for tax on remuneration received from his government. Okay. Similarly, if there is a foreign company, who is sending his employees, a foreign company is sending his employees, he is sending his foreign national employees. Again, the employee has to be foreign national. He should not be Indian citizen. He is sending his employees in India for some business purpose. And that during that business purpose, that employee stays in India. And he also gets remuneration from his company. Then that will be exempt. Subject to three conditions. That foreign company should not be engaged in any business or trade in India. That foreign company should not be engaged in any business or trade in India. Secondly, that employee does not exceed his stay in India for more than 90 days. He can stay up to 90 days, but he should not stay for more than 90 days. Okay. And third, that foreign company, that is the employer, should not claim that expense as a deduction. Whatever remuneration is paid to the employee when he was in India up to 90 days, that remuneration should not be claimed as a deduction under income tax law, under any provisions of the Income Tax Act 1961. If all these conditions are fulfilled, the remuneration received by the foreign employee who is a foreign national of a foreign company will not be taxable in India. I hope it is clear to all of you.
Now let's move on to one last exemption, but which is the biggest out of all of them, that is section 1023 FE, which is for certain specified person. So first of all, we need to identify who are the specified person to whom this exemption is given. Then we will see what is the exemption which is given over here. Now the very first thing which we need to see over here, specified person, the definition of specified person covers 3 points. Point number A, point number B, and then point number C. Okay, B and C is more or less similar to each other. Let's see one by one all of them. Who is the first specified person? It is a wholly owned subsidiary of Abu Dhabi Investment Authority, a resident of UAE, and makes investment directly or indirectly out of the fund owned by the government of Abu Dhabi. So the government of Abu Dhabi has made one entity, but that is known as Abu Dhabi Investment Authority. So it is wholly owned subsidiary of the government of Abu Dhabi. So that company is going to invest in India. Okay. So this is the first specified person. Who is the second specified person? It is a sovereign wealth fund. Now, what do I mean by sovereign wealth fund? A sovereign wealth fund means it is a wealth fund of a foreign country, of a foreign government, which will fulfill certain conditions. First of all, it should be a wealth fund which is owned by the government of a foreign country. It is set up under the law of foreign country. Now, the third condition, all its earnings, whatever it earns, it will be credited to the government of India, and no portion of its earnings should be given to any private person. So whatever is earned by that foreign sovereign wealth fund, it should be given to the government of that particular country and not to any private person. Plus, on dissolution, whenever that wealth fund will be dissolved, all the assets will be given to the government of that country. Okay. So all the earnings will be given to the government of that country. On dissolution, all the assets will also be given to the government of that country. But there is one proviso to both these points, which says that if the government has taken any loan or something on credit from somebody, then obviously the earning has to be given to them also, and on dissolution also the assets has to be given to them also. Okay. So if they have taken some creditor or some loan from somebody, then obviously they have to give that money to the respective creditor and respective lender also. Okay. Next, condition number 5, that foreign wealth fund should not participate into the day-to-day operations of the investee. Who is an investee? Investee is an entity in which they are investing. So they should not participate into the day-to-day operations of the investee. But to protect their investment, they can definitely appoint directors in India or executive directors in India, because they are investing in India such a huge amount. They have the right to protect their investments. Okay. And the last but not least, the central government of India will notify that particular sovereign wealth fund. Then only it will become a specified person. Otherwise, it will not become a specified person. Similarly, the third category of specified person is a pension fund of a foreign country. It's a pension fund of a foreign country which is registered under the law of that country. It is not liable to tax in that country. It is not liable to tax. It is exempt under the taxation laws of that country. It will fulfill some other conditions as may be prescribed, and condition number 4 and 5 is similar to the previous section only. Okay. So these are different kinds of specified persons which are covered. Now, which incomes of the specified persons are exempt? The dividend income of specified person is exempt. The interest income of specified person is exempt, and certain incomes which are amended by Finance Act 2023 under section 56(2)(12), which is business trust income. Business trust income is exempt, and long-term capital gain is exempt from investment made in India in debt, in share capital, or in unit of business trust. Okay. When they should make an investment, where they should make an investment, that I have told you. They should make an investment in debt, equity share or share capital or unit, and they will earn dividend, interest, business trust income or long-term capital gains. And they should make an investment between 1st April 2020 to 31st March 2024, and they should hold the investment at least for how many years? At least for 3 years. Now, the last thing and the most important thing of this section, where they will make an investment. They will make an investment in 5 different sectors. First, they will make an investment in business trust, and from the business trust, they will earn some interest, dividend or capital gains that will be covered over here, which is exempt. Second, they will make an investment in a company or an entity which is engaged in infrastructure facility in India. So any like Adani infrastructure. So if a company which is engaged in infrastructure facility in India, they will invest in that company. Or the third thing, listen carefully, they will invest in an AIF, that is an alternative investment fund. What kind of AIF? Which invest at least 50% of its money in point number B company or point number D company or point number E company. So they will invest in an AIF, and in return the AIF will invest at least 50% of its funds where? In point number B, point number D and point number E. Now the fourth one, they will invest in a domestic company. Which kind of domestic company? Which is newly registered on or after 1st April 2021. It should be recently registered domestic company with minimum investment of 75% in which company? In point number B, that is in Adani Enterprise. That is in point number B, that is a company which is engaged in what? Infrastructure facility in India. And last, again an NBFC, the specified person will invest in NBFC, and that NBFC will lend minimum 90% to point number B, that is to Adani Enterprise. Example, I am not saying Adani Enterprise is a beneficiary of this section, I am just giving one example. So they will invest where? In NBFC, and NBFC will lend at least 90% of this income to the point number B company. Okay. Now, in future, if they fail to fulfill any condition, then whatever exemption they have claimed earlier, it will become deemed income, it will be chargeable to tax. What are they, how they can fail to fulfill any condition? Because one of the condition mentioned in the section is they should hold the investment at least for 3 years. So in future, if they are not able to hold the investment for at least 3 years, and if they sell within 2 years, so whatever exemption they have claimed earlier, that will be deemed income. One last thing, be very careful. There is a condition over here in point number C that at least this AIF should invest 50% in point number B, C, B, D and E. And this domestic company should invest at least 75% and at least 90% this NBFC should lend. Okay. So if they invest or lend less than the percentage prescribed, then they will not enjoy exemption. But if they invest or lend more than the percentage prescribed, they will enjoy exemption. But if they want full exemption, they should invest 100%. Because if they invest less than 100%, then they will only enjoy proportionate exemption. For example here, how much percentage they should invest in B, D and E? 50%. Suppose if they invest 70%, they are fulfilling the condition, but only 70% income will be exempt, not 100%. If they want 100% income to be exempt, then they should invest entire 100% in B, D and E. I hope it is clear to all of you. Last but not least, they have given a definition of liable to tax, which is similar to what we have done earlier under the residential status clause also. I hope it is clear to all of you. Again, this section I don't think so. It's very important for exam. Now let's move on to the next section, which is very important for examination. 115 BBA and section 194E, that is non-resident sportsman, non-resident sports association and entertainer. Let's see. If there is a non-resident sportsman who is not a citizen of India, he should not be a citizen of India. Be very careful. If he participate in any game or any sport in India, or if he earns any income from advertisement or contribution of any article in any in any newspaper, magazine, etc., all three of them will be subject to flat 20% tax under the income tax law. Okay. Apart from that, a non-resident sports association, if they are getting some guaranteed money from any Indian person, so if they are, suppose like ICC, International Cricket Council, is getting some money from BCCI for arranging an event in India, so that will also be subject to 20% tax. This was also held by Supreme Court in this particular case, and that case is mentioned over here. Okay. That if the World Cup is held in India, if the cricket World Cup is held in India, then whatever income is earned in India, if it is paid to the ICC or to any other cricketing board of another countries, then that will be subject to deemed to accrualize in India. That will be subject to 20% tax in India. Okay. And the third one is, if there is an entertainer who is a non-resident and who is not a citizen of India, non-resident as well as not a citizen of India, if they earn anything from performance in India, that will also be liable for 20% tax in India. Okay. Now, whether they will get any deduction of any expense, no deduction of any expense or allowance will be allowed from this income. This will be directly taxable at 20%. Whether they are liable to file income tax return, only if they earn above income and the TDS is deducted, there is no need to file the income tax return. If they earn only this income and the TDS is deducted, there is no need to file the income tax return. TDS will be deducted under which section? Under 194E at the rate of 20% on payment or credit, whichever is earlier. There is no threshold for deduction of TDS.
Every time you make a payment, TDS will be deducted. Whether umpires and referees will be covered under this section. Umpires and referees are not covered under this section because umpires and referees cannot be called as sportsmen. They are professionals, but they are not sportsmen. Therefore, their TDS will be deducted under section 195 if they are not resident, or under 194J if they are resident. Okay. This section, flat 20% tax, no basic exemption limit will be allowed of 2.5 lakh or 3 lakh rupees. I hope it is clear to all of you. Now, the next provision is again not very important. The previous one was very, very important, but this one not very important for examination. That is 115JG, conversion of an Indian branch of a foreign bank. That is, suppose there is a Bank of Germany which is located in Germany, obviously, and there is an Indian branch of that particular German bank. Now, the RBI and the central government is requesting the Indian branch of that foreign bank to convert that into Indian subsidiary. So now, if they convert that into Indian subsidiary, there are a lot of questions which the Indian branch is asking. What about the capital asset we will transfer, whether we will get the capital gain exemption or not? So the law says that, yes, 115JG is a special provision overriding the entire income tax law. It says that when you convert an Indian branch of a foreign bank into an Indian subsidiary, whatever capital assets you will transfer, all of them will be exempt under income tax law. Second question, what about the losses and UID which are there with them? That will also be allowed to be carried forward to the Indian subsidiary. What about the MAT credit, if any, it is there with the Indian branch? That will also be transferred to the Indian company. The entire scheme should run as per the scheme notified by the central government, and the central government has given a notification. According to that, it should work. Okay. So how it should work? It should work according to the following boxes. Let me talk about all of them one by one. So what will happen with the current year depreciation when the conversion is happening? The current year depreciation will be apportioned between the Indian branch and the Indian company on the basis of number of days the assets are used by them. Okay. I hope it is clear. So what about the losses and set off of carry forward and losses and UID? Yes, you can carry forward the PGBP loss other than the speculative loss. Speculative loss will not be carried forward. Non-speculative loss you can carry forward, and you can also carry forward unabsorbed depreciation, and you can carry forward for another 8 years. You can carry forward for fresh 8 years, just like amalgamation of companies. I hope it is clear to all of you. So what will be the WDV of the assets in the hands of the company? It will be same as the WDV in the hands of the Indian branch. Whatever is WDV in the hands of the Indian branch, that will become the WDV in the hands of the Indian company for the purpose of depreciation. So what will be the cost of acquisition of the capital assets if later on Indian company wants to transfer some assets? Suppose if there is any land coming from the Indian branch, what will be the cost in the hands of the Indian company? The cost will be the cost to the Indian branch only. So whatever is the cost to the Indian branch, that will become the cost in the hands of the Indian company. This is what it is given. Period of holding should also be clubbed from the day on which the Indian branch has purchased the asset to determine the asset, whether the asset is long term or short term. Okay. MAT credit can also be carried forward by the Indian company for another fresh 15 years. For fresh 15 years, another 15 years, you can carry forward the MAT credit. Okay. What about VRS expenses? VRS expenses are allowed for a period of 5 years. Whether it will be allowed to the Indian company for the balance number of years, it will be allowed to the Indian company for the balance number of years. What about provision for bad debts? Do you remember that in case of banking companies, and this is the banking company only, in case of banking company, you get the deduction of provision for bad debts and also actual bad debts. But when you get the actual bad debts, the actual bad debts is allowed when the actual bad debts is greater than the provision for bad debts. And when you compare the actual bad debts with the provision for bad debts, which provision for bad debts you take? You take the opening balance as well as the current year provision. And opening balance and current year provision, you take and you compare that with actual. If actual is more than both of them, then you will get the deduction of actual bad debts. So here also, when you will compare the actual bad debts of the Indian company, the new company, you will compare with the provision of the Indian branch also, Indian branch provision also, and also the provision which you have made in the current year. This is what it wants to tell you. Okay. Now, what is the company going to get? What is the German bank going to get in return? The German bank is obviously going to issue shares, and it is going to get the shares. So the shares which are received by the German bank, whether it will be liable for gift tax under the income tax law, the answer is no. 56(2)(10) will not apply. Obviously, today the branch is a part of the existing entity, but when that branch is converted into an Indian company, then the HO has to issue shares now. HO has to purchase the shares of the Indian company, right? So Indian company will give the shares to the German company, and therefore the German company will get shares from Indian company for free without any consideration. So whether the gift tax will be applicable, gift tax will not be applicable over here. Okay. Later on, if you violate any of the conditions, then whatever exemptions and whatever the relaxations, whatever the benefits which are given to you will be all taken from you, and your order will be rectified under section 154 within 4 years from the end of the financial year in which
you have made the violation. Okay, so if you should not make any kind of violation which are mentioned in this particular notification, you should follow this notification by your heart. You should not misfollow, or you should not ignore this notification from any aspect. If you do that, your exemption and deduction and set off of loss, whatever it is there, all of them will be disallowed in your hands. Okay, now coming to the next part, which is very, very, very important for exam, that is presumptive income for non-residents. There are 4 sections for presumptive income of non-resident, that is 44B, 44BB, 44BBB and 44BBA. Let us talk about the first one, that is 44B, which is very important. Against that, there is also one more section, which is section 172. You have to read both of them together. This is for non-resident shipping business. Suppose if there is a non-resident who is engaged in shipping business, how is the income tax will be computed? How will the income be computed of such non-resident? Remember, whenever a non-resident comes to India with his ship, and when he leaves India with passengers, with carriage of passengers, with carriage of goods, livestock or mail, then whatever revenue he has earned, 7.5% will be deemed to be income. Okay, while computing 7.5%, he should also take the demurrage charge and handling charges. Both of them should also be included in the revenue and then take 7.5%. Now, this is as per section 172. And when he is supposed to pay this, he should pay this before leaving India. So 172 overrides the entire income tax law. So suppose when you came to India, a non-resident shipping ship owner came to India and he is leaving India. He is leaving India with carriage of passenger, goods, livestock, etc. and he is earning 100 crore rupees or 100 lakh rupees. So 7.5% of 100 lakhs will be deemed income. He has to pay tax on that. Will he get any deduction of any expenses? No PGBP deduction, no set off of loss, no chapter 6A, nothing will be allowed at this moment. And what will be the tax rate? 100 lakhs is the revenue, 7.5% is the income, 7,50,000 is the income. What will be the tax rate? The tax rate will be directly 40%. Why? Suppose if that person is individual, then also 40%. Suppose if that ship owner is an individual HUF, then also 40%. Yes, then also 40%. For everybody, it is 40%. As per section 172, it is 40% for everybody. Everybody will be liable for 40% income tax. Now listen carefully. Section 172 is a recovery section. This section is intended, it has been made to recover tax from non-resident. Otherwise, these people will not give any taxes to India. Okay. Now, in the next year, if that non-resident is honest enough, he has an option to follow section 44B. And in 44B, he can come under 44B and he can show 100 lakh as revenue, 7.5% as income, 7,50,000. Again, 44B also does not give you any PGBP deduction because 44B also overrides the PGBP provisions from 28 to 43. Again, you are not going to get any PGBP deduction. But few deductions which were not allowed under 172 will not be allowed. That is, if there is any chapter 6A, you can claim against this income. If there is any set off of loss, if there is any losses in India which you can set off against this business income, you can set off that loss, and the differential amount is obviously going to come as refund. The government will give you the refund. Why? Because the amount which you have paid in 172, that will be treated as an advance tax. So that will be treated as an advance tax, and the differential amount will be paid back to you, will be refunded back to you along with the interest. I hope it is clear to all of you. So what is the difference between 172 and section 44B? 172 is chargeable in the previous year. 44B is chargeable in the assessment year. Okay. Now, one more income will come in 44B, which is not covered in 172. Suppose the ship is leaving from UK and it is going to US. So, if the ship is leaving from UK and it is going to US, 172 is not applicable. In that case, if the money is received in India, then directly 44B should be applicable. This income is not covered in 172 because for 172 apply, the ship should leave India. But if the ship is not leaving India, it is leaving to different countries, but the money is received in India, then that amount should be directly taxable under what? Under section 44B. Now, how 44B and 172 is different? 44B is a charging section. 172 is a recovery mechanism. 172 only covers one income. That is where the goods are shipped from India. But 44B covers two income. The one, where the goods are shipped from India, and another where the goods are shipped from any port outside India. Now, the third difference between both of them. In 172, there is a flat tax of 40%. But in 44B, you will be liable for normal tax rate. In 172, you are not going to get any deduction. In 44B also, you will not get any deduction of PGBP. In 172, you are not going to get the set off of loss also. But in 44B, you are going to get the set off of loss. In 172, you are not going to get the deduction of chapter 6 also. But in 44B, you will get at least 44B, you will at least get chapter 6 deduction. I hope it is clear to all of you. So always follow 172 first and then 44B in the assessment year, and then whatever is the differential tax, that will be refunded to you, and the amount paid under 172 will be treated as what? As your advance tax. Okay. Now let's move on to the next section, that is 44BBA, which is for non-resident aircraft business. Now, if the aircraft is leaving India, then it is taxable in India. Or if the aircraft is not leaving India, it is leaving from some other country, but money is received in India, then also it is taxable in India. So either it should leave India, then it is taxable in India, or it should leave some other country and it should be received in India, then it is taxable in India. How much will be deemed income? 5% will be deemed income. That's it. Nothing else is there. Only this much is there. Nothing else is there. Okay. 5% will be deemed income. So here there is nothing like 172. Yes, there is nothing like 172 over here. 172 is only applicable for shipping business. It is not for airline business. Now the third section, 44 triple B. One very important thing you have to keep it in mind for 44 triple B, that 44 triple B is only applicable to foreign companies. It is not applicable to all non-residents. The previous two section was applicable to all kind of non-resident, whether you are a company, individual, HUF, AOP, BOI, firm, LLP, etc. But this section is only applicable to foreign company. Now, what is this foreign company doing over here? The foreign company is engaged in the business of civil construction or erection of plant and machinery, testing, commissioning as a turnkey project. Okay, so they are mainly engaged in civil construction, erection of plant machinery, etc. Whatever income they will earn, of that 10% will be amount to be deemed income. Okay, plus one more thing, one benefit which is there over here, which is not there in the previous section, that if the assessee claims that his actual profits are lower than 10%, if the assessee claims that his actual profits are lower than 10%, then assessee can do that also. Assessee can maintain books of account, can conduct tax audit and show lower profit also. That is also allowed. Okay, I hope it is clear to all of you. In 44 BB, again all kind of non-residents are covered, company, HUF, AOP, BY. Only 44 triple B, only foreign companies there. Okay, in this section, what is the non-resident doing? The non-resident is providing some services or some facilities, or the non-resident is providing plant and machinery and hire. So the non-resident is providing you some services, some facility or plant and machinery or hire. For what purpose? For prospecting, extraction or production of mineral oil. Because you want to extract mineral oil or prospect mineral oil or produce mineral oil, that's the reason they are providing all these services or facilities or plant and machinery or hire. Your deemed income will be only 10%. Here also, if you want to claim that your lower actual profits are lower, you can show actual profits as lower by maintaining books of accounts and by conducting tax audit. Okay. Now the question over here is, here the facility or the service which is given, what about if that service is a technical service? If that service is not a normal service but it is a technical service, then you have to follow 115A or 44DA and not 44BB. Okay. This 44BB is only applicable if it is not a technical service. If it qualifies to be a technical service, then follow 115A or 44DA as the case may be. Okay. Now here also, now in this section, remember I have told you as a comparative basis, that is under 44 AD, under 44 ADA and AE, which we have done in PGBP. In those sections, do you remember, the AO can assess your higher income also, higher than what is deemed profit. Remember, in those sections, the AO can assess your higher income. Suppose if your deemed income is 8%, and if the AO says that no, in 44 AD deemed income is not 8%, it's 12%, then AO can assess at 12% also. Okay, do you remember that? But in these sections, in this chapter, the AO cannot increase your income beyond the deemed income. Maximum your income will be up to deemed income, whatever it is mentioned in these sections. It cannot be more than the income mentioned under these sections. Okay, I hope it is clear to all of you. Further, in all these sections, if the foreign company only earns these incomes, that is these four incomes, then there is no MAT applicable on the foreign company. So if the foreign company is only earning these four incomes, the provisions of MAT will not be applicable on the foreign company. Now, one amendment which is made by Finance Act 2023 for this section and the previous section, for 44 double B and 44 triple B also, that is, they will not get the deduction of any UAD or brought forward losses of earlier years. So if they want to set off any UAD or brought forward losses against this income, it is not allowed to set off against. Okay, against this you cannot set off all these incomes. I hope it is clear to all of you. And one last section over here is of non-resident having a branch in India. If a non-resident has a branch in India and head office is allocating some expenses to the Indian branch, then how much deduction will be allowed? Will they allow full deduction to them? No. It is allowed subject to lower of the two. Lower of what? Whichever is less, 5% of the adjusted total income or the actual expense attributed to the Indian branch, whichever is lower. So 5% of adjusted total income will be compared with the expense which is attributable to the Indian branch, whichever is lower. So what is adjusted total income? Adjusted total income means nothing but total income, but after adding all these items. What all things you will add back? UAD, you have to add back to the adjusted total income. Okay. So add UAD to the total income. Add set off of loss to the total income. Add capital expenditure of family planning, not scientific research. Capital expenditure of family planning should be added back. Add chapter 6A and add already if any expense is debited to the P&L, that also you should add it back. I hope it is clear to all of you. Now let's move on to the next point, that is which incomes are deemed to accrue or arise in India, which is mentioned in section 9. Only income which are deemed to accrue or arise in India will be liable to be taxed in India. or income which is received in India are liable to be taxed in India. First of all, we'll talk about business income. When business incomes are liable to be taxed in India, be very careful. For that, we need to have a business connection in India. If a non-resident has a business connection in India, it is liable to be taxed in India. Now, what does business connection include? Business connection means any business activity which is carried on through a person in India. If a non-resident is doing any business activity in India through a person in India, it will be called as business connection. Now, there are multiple levels of business connection. First of all, if a non-resident has an agent in India, who has an authority to habitually exercise contract on behalf of non-resident. So, if a non-resident has an agent in India who habitually exercise contract in India, then that is also a business connection in India that will be liable to tax in India. Second, if the non-resident does not have an authority, to habitually exercise contract in India, but he has the authority, he has the power to deliver. He has been told by the master, he has been told by the non-resident, his agent has been told by the non-resident that you should deliver goods in India regularly. Your duty in India is only to deliver goods in India, then that is also amounting to business connection as per the income tax law. Third one, he does not have any authority, he does not deliver goods also, but he only secures orders in India mainly and only for the non-resident. He only secures order for you. For the master, he secures orders in India, then that is also deemed to accrue a rise in India. That also amounts to business connection in India. Okay. Now, suppose if he only secures order for you, but he also secures orders for some of the orders for your brother also, and your brother is controlled by you, or you control your brother, or to both of them some other third person your father is controlling. So in that case also, if you try to divide your income, if you try to divide your orders between different parties and all the parties control to each other, then that also amounts to what? Business connection. I am again saying, I am working, I am an agent, I am securing order mainly and wholly for you, but I am also securing some orders for your brothers. I am not working wholly and mainly for your brother, but your brother controls you, or you control your brother, then business connection will also be established for your brother also. Okay. Last but not least, only agents who are having some dependent status will be covered over here. Independent agents will not be considered to be business connection. Only dependent agents will be considered as business connection. Okay. Now coming to very, very important concept of another level of business connection, that is significant economic presence. What is significant economic presence? If any entity, any non-resident has a significant economic presence, then that also amounts to business connection. But what is significant economic presence? If any non-resident is entering into a transaction of any goods, service or property carried out by non-resident, if non-resident is entering into a transaction with any person in India and the aggregate payment made to that person is more than 2 crore rupees, or if that non-resident has more than 3 lakh users in India, at least 3 lakh users in India. So if non-resident enters into a transaction with any person in India and the person in India pays more than 2 crore rupees, or if that non-resident has 3 lakh users in India, then that non-resident has business connection in India. That non-resident has significant economic presence in India and it will be liable to be taxed in India. Okay. I hope it is clear to all of you. In that case, it does not matter whether the non-resident has entered agreement in India or not, whether the non-resident has residence or place of business in India or not, or whether the non-resident renders services in India or not. It doesn't matter in that case. In that case, all these things does not matter, is of no role to play. Okay. Now, some incomes some activities will not be considered as business connection, which are mentioned over here. First of all, if all the operations are not carried out in India, then only a proportionate income will be taxable in India. But few incomes will always be taxable in India. Which are those few incomes? These are those few incomes. An income from advertisement, from targeting. Suppose Amazon is doing some advertisement for Facebook, or Amazon is doing some advertisement for what? For, say for example, you can take Samsung. If Amazon is doing some advertisement for Samsung and Samsung is targeting Indian customer, for that Amazon is asking the Samsung, you want to target which customer? So Samsung is saying, I want to target Indian customer. So whatever income is earned by Amazon from that will be deemed to accrue rise in India. Okay. Secondly, if Amazon is collecting data from a person residing in India and then selling it. So if Amazon is collecting some data from an Indian resident company and then selling it to someone, that will also be deemed to accrue rise in India. And with the help of that data, if somebody is selling goods in India, with the help of that data, if somebody is selling goods in India, then that will also be deemed to accrue rise in India. I hope it is clear to all of you. Next one. If a non-resident is coming to India for purchase of goods, for what purpose? Only for the purpose of export. The non-resident is coming to India, purchasing some goods and then exporting it. Then that is not deemed to accrue rise in India. Or if the non-resident is coming to India as a news agency for collection of news and views in India, for transmission out of India, they are not transmitting in India, then that is also not deemed to accrue rise in India. So next, if a non-resident is coming to India for shooting of a cinematographic film, for what purpose they are coming? They are coming for a film shooting.
then that is also not accrued in India, not taxable in India, subject to some condition. If the non-resident is an individual, he should not be a citizen of India. If it is a firm, no partner should be citizen or resident of India. All the partners should be foreign citizens, all the partners should be non-resident. And if it is a company, no shareholder should be resident, no shareholder should be citizen of India. Okay, if these conditions are fulfilled, they will enjoy the benefit of exemption over here. Their income will not be liable to tax in India. Next one, if a foreign company is coming to India to display their uncut and unpolished diamond, so if a foreign company is coming to India to display their uncut and unpolished diamond in special zone notified by the government, which is in Mumbai, BKC, Bharat Diamond Boards, which I have told you in class, then that income will not be deemed to accrue or arise in India. Okay, here completes your business income. When your HP income and IFRS income will be accrued in India, when the property or the source of income is in India. If the property is India, then HP income is accrued in India. If the source of income is in India, like debentures is of Indian company, shares is of Indian company, etc., etc., bank is of Indian bank, then in that case, whatever income you earn out of that, the source is Indian income, therefore it will be accrued in India. Okay, now when salary income will be accrued in India as per section 912, when the services are rendered in India. Whenever the services are rendered in India, the salary is accrued in India. Then in that case, for rest period also and for leave period also, whatever salary is earned by the SSC, that will also be accrued in India. Next, when an Indian government pays salary to its citizen out of India. Suppose Indian government is paying salary to a citizen in UK because they are working in the Indian embassy in UK. That is also accrued and deemed to accrue or rise in India. Okay. But the allowances and the perquisite which are paid by the Indian government, that is exempt under section 10(7). So allowances and perquisites will not be taxable. Apart from that, the salary will be taxable in the hands of the Indian citizen outside India. Okay. Last but not least, over here, when an Indian company pays dividend to any person outside India, then that is also deemed to accrue or arise in India. Okay. Now let's come to the next point. That is section 9A, which is fund manager of offshore fund. Not very important section for exam, but still it is my duty to address each and everything with a disclaimer that what is important and what is not important. Now, what is fund manager of offshore fund? There is a fund which is outside India. Okay. The fund is definitely outside India and there is a manager in India. Just because the fund is managed by an Indian manager, that does not mean that the income of that fund will be deemed to accrue or rise in India. Okay. So therefore, if a fund is outside India and the manager is in India, then that income will not be deemed to accrue or rise in India, subject to 17 conditions. So if they want the exemption, if they want the relaxation, 17 conditions has to be fulfilled. 13 conditions has to be fulfilled by the fund. 4 conditions has to be fulfilled by the manager. So what are those 17 conditions? 13 conditions will be fulfilled by the fund and 4 conditions will be fulfilled by the manager. Let me talk about all the conditions one by one. First condition, the 13 conditions which has to be fulfilled by the fund first, and then the 4 conditions which has to be fulfilled by the manager. Let me talk about the first one. The fund should be non-resident in India. The fund should be located in a country with which India has a DTAA. The Indian resident should not invest more than 5% in the fund. So the resident's investment in the fund should not be more than 5%. Okay. But the eligible fund manager can invest up to 25 crore up to 3 years. Okay. So by default, the Indian resident should not invest more than 5%. But if the manager wants to invest, it can invest up to 25 crores. Even if it crosses 5%, it is okay for the first 3 years. The fund should be located in a country where there is an investor protection regulation like SEBI. In India, SEBI regulates all the funds. Similarly, in that country, there has to be some regulatory authority who should regulate the fund. Okay. Then the fund should have at least 25 members who are not connected to each other, who are absolutely unrelated to each other. They are not related party. The fund should have at least 10 members. At least any member along with the connected person should not hold more than 10%. Suppose if there are one person which is connected to another, then the 2 persons together should not hold more than 10% in the fund. Then 10 members along with the connected person, group of 10 members or less members along with the connected person should not hold more than 50%. Okay. So these are the 3 conditions. You have to be careful. E, F, G. These 3 conditions are not applicable to certain categories of fund that I'm going to say later on. Okay. So what are these 3 conditions? First, at least 25 members has to be there in the fund which are unconnected. Any one member with its related party should not hold more than 10%. And any 10 or less members with its related party should not hold more than 50%. Next, the investment in any entity. The fund should not invest more than 20% in any of the entity. Okay. The fund should not invest any money in its associate entity. In associate entity, fund cannot invest any money. Now next one, the monthly average corpus of the fund should not be less than 100 crore. It means every month the fund should at least have 100 crores as the average corpus fund. Okay. But if the fund is a newly incorporated fund, which is incorporated, let's say in the month of September or November or December, then within 12 months, they should achieve that 100 crore target. Within 12 months, they should achieve that 100 crore target. Okay. If the fund is going to wound up in the current year, it means it is going to be closed in the current year, then this condition is not applicable to the fund. I hope it is clear to all of you. Next one, the fund should not carry any business in India. The fund should not be engaged in any activity in India which amounts to business connection. Okay. And the remuneration paid to the manager. The fund has to pay some remuneration, a fixed remuneration to the manager.
that remuneration should not be less than the prescribed manner which the government will prescribe. Okay, whatever government will prescribe, the fund has to pay that much remuneration to the manager. Okay, now the condition of EFG is not applicable if the fund belongs to the government of foreign country or central bank of foreign country. So if the fund belongs to the government of Singapore or central bank of Singapore, then in that case this EFG is not applicable to be fulfilled. Then only 10 conditions has to be fulfilled out of the 13 conditions. Now what do I mean by eligible fund manager? To become an eligible fund manager, you have to fulfill 4 conditions. How many conditions? 4 conditions. First, the eligible fund manager should not be an employee of the fund or the employee of the connected person of the fund. He should be a registered fund manager. He should do an ordinary course of business. He is acting in an ordinary course of business, and he should not be given more than 20% of the profits. Okay, maximum how much profit should be given to him? He should be given maximum 20% of the profits, not more than that. Now the question will come, who will check whether all these conditions are fulfilled or not? That the assessee will check, and the assessee will comply, and the assessee will inform the government within 90 days by filing a statement in a prescribed form. The form is form 3CEK, not important to remember, just for the knowledge I am saying. The assessee has to fulfill, that is the eligible fund has to fulfill that form and give it to the government and tell the government that I have fulfilled all the conditions. Okay, now some of the conditions which we have read so far is not applicable if the fund manager is located in IFSC. So if the fund manager is located where? In IFSC, then some of the conditions are either not applicable or some of the conditions are applicable with some kind of modification. Okay, now condition EFG, which was not applicable to the foreign government, are not applicable even if the fund manager is located in what? IFSC. Similarly, condition K. What is condition K? You can come over here and see. Condition K said that the fund shall not carry or control manage any business in India. So this is modified little bit. The fund shall not carry day-to-day operation. This is just like section 1023 FE, if you remember. Do you remember that? Section 1023 FE, same condition over here. Okay. Similarly, in the definition of eligible fund manager, it is written that the fund manager should be what? Should be a registered fund manager. So here it was not written registered as what? Registered under which law? So here it is written it should be registered as per the IFSC authority law. So he should be registered as per the IFSC law. I hope it is clear to all of you. Okay. Now let's go on to the next one, that is section 195, very important section of TDS. The most important section of TDS for non-resident is 195 only. Who will deduct TDS? Any person. Who is any person? Any person can be any person. Any person can be resident, any person can be non-resident, any person may have place of business, residence in India, may have any presence in India, may not have any presence in India. So the deductor can be any person. Always remember, under section 195, the deductor will be any person. Any person, resident, non-resident, everybody can be deductor, but the deductee has to be non-resident and foreign company only. The deductee will be only non-resident and foreign company, and you will deduct TDS of interest other than 194 LB, LCAT, because these 3 are already covered under respective section. Or you can also deduct TDS of salary other than salary, because salary is also covered under section 192. Apart from that, all other incomes will come over here. But one of the important condition to deduct TDS over here is the other person's income. The pay's income should be chargeable to tax in India. If the pay's income is not chargeable to tax in India, then you are not supposed to deduct TDS over here. Be very careful. You will deduct TDS under this section only if the pay's income is chargeable to tax in India. Okay. You will deduct at what rate? The rate will be rates in force. There is no fixed rate given over here. For rates in force, we have to follow the relevant Finance Act 2023. There it is written what is the rates in force. So who is the deductor? The deductor is any person. Resident, non-resident, have a presence in India, does not have a presence in India. Everybody has to deduct TDS. Who is the payee? The payee has to be non-resident or foreign company. When TDS has to be deducted? When the income of the other person is chargeable to tax in India, then only then deduct, otherwise don't deduct. Okay. At what rate you will deduct? Rates in force. Okay. I hope it is clear to all of you. Now the very important question, what is the timing of deduction? Generally you should deduct TDS on credit or payment, whichever is earlier. But in some cases, you should deduct TDS only on payment basis, not on credit basis. This is a very important point which is asked by institute a lot of times. Okay. So what is that case in which you have to deduct TDS on payment basis, not on credit basis? When interest is payable by government or public sector bank or public financial institution. When interest is payable by these 3 people, you have to deduct TDS on payment basis, not on credit basis. I hope it is clear to all of you. Now further, there are some formalities that you have to fulfill as an assessee. When you are making payment to a non-resident, any kind of payment you make to non-resident, you have to fill certain forms, and that is form 15 CA, 15 CB. When that has to be filled? Always, whether the income of the non-resident is chargeable to tax or not chargeable to tax. You have to always fill this form. Filing of this form is mandatory. Without that, you cannot send money outside India. If you want to send money outside India, you have to fill this form, which is also called as remittance certificate in your normal language. Okay. Further, when I am making the payment, I have to check whether the income of the other person is liable to tax in India. If the income of the other person is not liable to tax in India, I should not deduct the TDS. Now the question is, I am feeling that the income of the other person is liable to tax, but not 100% liable to tax. It is proportionately liable to tax. Then what shall I do? I should deduct tax on a proportionate basis. Who will determine that what should be the proportion? You have to make an application to the assessing officer. When you feel that the whole of the income is not chargeable to tax, when you feel that, when you know that the whole of the income is not chargeable to tax, you should make an application and to the AO, and the AO will determine the appropriate portion, and accordingly only that portion you should deduct TDS, and only that portion will be subject to TDS deduction. You should not deduct TDS on the entire amount. Now then there are some small case laws, not very important for examination. First of all, the assessee made some payment to a non-resident where the income was not chargeable to tax. Okay, so therefore the assessee did not deduct the TDS. Why will I deduct the TDS if the income is not chargeable to tax? The AO made a disallowance under PGBP. Can the AO do that? The answer is no. If the income is not liable to charge, then why will I deduct TDS? And in that case, if I have not deducted the TDS, you cannot disallow my expense. Now, that expense should not be disallowed. That expense should be definitely allowed to the assessee. Next case law, a very important case law. This they have asked many times in the examination. There is an overseas agent outside India. He is providing some services outside India. So the agent is outside India. He is providing some services outside India. He did not perform any service in India, and you are making some payment to him. Are you supposed to deduct TDS? The answer is no. His income is not deemed to accrue or rise in India. Therefore, you are not supposed to deduct the TDS in that case. Okay. Now, the next section, 239A, is a recently inserted section which was brought in Finance Act 2022. What is this section? Listen carefully. I am in India. I am a payer. You are outside India, you are a payee. Now, generally what happens, if I am making some payment, I am supposed to deduct the TDS, but there is an agreement between me and the other person. Whatever tax will be there, that will be borne by the payer himself. Okay, that the payer will bear the tax, payer will gross up the income and will pay the tax. Now, the question is, I am payer, you are payee. So, I grossed up the tax and I paid the tax. But sometime after that, I came to know that this income was not liable to tax only. Then I am just asking a question to myself, why the hell I have deducted, why the hell I have paid the tax from my pocket? Because this income is not liable to tax. So in that case, where you have borne the tax is borne by the payer and it is paid to the government, and later on if you come to know that there was no need to deduct any tax, but still you have paid the tax, it means you have paid excess money to the government. So in that case, this section gives you relief that you have to make an application to AO within 30 days and AO will refund you such tax. Okay, then AO will pass an order allowing you or rejecting the application. If he allows you, he will refund you. If he rejects it, he will give you an opportunity of being heard, and then you can make an appeal within 6 months. Okay, now the order will be passed within 6 months. You can file an appeal against that if you want to file an appeal. So this section gives you some kind of relaxation with respect to what? With respect to where you have borne the tax, but later on you came to know that you are not liable to bear only, you are not liable to pay. But unfortunately, you have already paid, so you should get your money back. Okay, so this is what this section is all about. Now, one last thing which is very important for exam. This rule 115 is absolutely important for exam. Mark it down. There are a lot of questions which can be asked on this. We have also done a lot of questions in our past RTPs, past MTPs and past exam papers. Remember or not, we have done a compilation of 23 papers for you all, covering almost 90% of the examination question that can be asked in the examination. Nothing beyond that can be tested by ICI. Very difficult for ICI to test beyond that. But still, you have to know the complete subject properly before going in the examination. That's the reason only relying on those compilation may not be sufficient. That's the reason we are also putting the revision videos for you all, which will give you comprehensiveness about the subject. Now, what is this rule 115? If you are earning some income in foreign currency, how will you convert that into INR? You will take TTBR on specified date. But what is specified date? Now, specified date is different for different categories of income. For some incomes, specified date is the last day of the financial year. That's it. That is 31st March 2024. But for some income, specified date is the last day of the preceding month in which you earn. So in some case, there is one single date, last day of the financial year. In some case, it is last day of the preceding month. So let's see what is a specified date for income from house property and for PGBP. Other than the PGBP mentioned in point number 3 over here, okay, and other than dividend and interest and securities and IFOS. So listen carefully. For income for house property, headwise we will talk. For income from house property, last day of the previous year, convert that foreign income into Indian income. Okay, 31st March 2024 TTBR, convert that house property income into Indian income. For PGBP, other than this point number 2 PGBP, convert last day 31st March into Indian. For IFOS, convert last day 31st March into INR. But for dividend and interest, follow point number 3. Okay. Now point number 3 will have all the remaining incomes. Salary not covered in point number 2, so it will come in point number 3. Interest on security not covered in point number 2, come in point number 3. That one PGBP is PGBP in case of non-resident shipping business, that is 44B wala section, 44B. That is non-resident shipping business. Dividend not covered in point number B, so come over here, and capital gains not covered in point number B. So all these incomes which are covered in point number number 3 will be converted as per the last day of the immediately preceding month. So if you earn in December, you have to take TTBR of 30th November. If you earn in July, you have to take TTBR of 30th June. This is how you are going to compute the income in case of this particular point number 3 incomes. Okay, just remember one of them, and the rest, the second one will be the balancing figure. Okay, now further, when you are making payment to someone in foreign currency and you have to deduct TDS, so at that time you will convert at what rate? Okay, suppose if I'm making some payment to a non-resident of $10,000, which is in foreign currency, so I have to convert that also into rupees now. So if I deduct that $10,000, say 10% I have deducted, so $1,000 I have deducted. So how will I convert that into rupees? Because I have to pay to the government of India in rupees only. The government of India is not going to accept dollars. Okay, so that you have to take TTBR on the date of deduction. So whichever date you are liable to deduct, that day's TTBR you are going to take as per rule 26. Okay, so suppose if I am liable to deduct on 15th of March, so whatever is the TTBR on 15th of March, that day's TTBR will be used to convert that amount of TDS. Okay, I hope it is clear to all of you. So this is what this gigantic topic of non-resident is all about, which I have committed to you all that I will try my best to upload maximum of the revision videos in English also along with Hindi. It's not an easy task for me, but I have tried my best to upload maximum videos. Further, I will further try to upload few more topics like transfer pricing and all. Also, I will try to upload for you all. Okay. Apart from this, I have already uploaded a lot of things in English for you all. You will not get so much of content in full English in the entire YouTube. I have uploaded for you all the ICI MCQs. I have uploaded for you all the RTP discussions. I have uploaded for you all the very important compilation of 23 papers in English, which is much more than any other revision video. I have uploaded for you all PGPP, capital gains, assessment, set off, carry forward, penalties. Then I have uploaded taxation of trust in last lecture. Today I am uploading non-resident. Tomorrow I will try to upload what? Transfer pricing also. Okay. So this much I think so will be sufficient for you all. Till then, take care all of you. Bye.